So we'll go into deeper detail on itemized deductions for taxes that you paid during the tax year. We cover all of these deductions in our video on Schedule A, but in this video we're going to take a deeper dive on how to arrive at the calculations for taxes paid during the year. So taxes paid. Generally, you are allowed to take a tax deduction for state and local taxes paid during the year up to $10,000. For married taxpayers filing separate returns, that limit is $5,000. This includes income tax or sales tax, not both. It also includes real estate taxes and personal property tax, which we will cover in depth. So you can calculate the deduction for state and local income tax or state and local sales tax. You cannot include both. However, the default option on Schedule A is the income tax. If you choose to use sales tax, then you must check the box in line 5A to change this option to sales tax. This box right here. Taxpayers in states with no income tax can use sales tax. That's probably a no-brainer for many taxpayers. And you can include taxes that you paid to a U.S. possession as long as those taxes were not allocated or allocable to excluded income. So to calculate state income tax, you can include the following income taxes paid. Any state and local taxes that were withheld from your salary as you reported on W-2. However, you can't include taxes that were otherwise deducted elsewhere, such as on Schedule C or Schedule E. State and local taxes paid during the current tax year for a prior tax year. However, you cannot include penalties or interest when you make this inclusion. So only the taxes, not any penalties or interest that the state or local government might have imposed for non-payment of those taxes. Estimated taxes that you made during the year, and this includes part of a prior year refund that you credited to the current tax year. If you made mandatory contributions to a disability fund sponsored by a state government, you can include those in your calculation. Examples specifically from the form instructions include the California, New Jersey, or the New York Non-Occupational Disability Benefit Fund, the Rhode Island Temporary Disability Benefit Fund, or the Washington State Supplemental Workmen's Compensation Fund. If you made a mandatory contribution to a state unemployment fund, specifically Alaska, California, New Jersey, or Pennsylvania, you can include this in your income tax calculation. And finally, if you made mandatory contributions to state family leave programs, such as the ones sponsored by either New Jersey or California, then you may include that in your income tax paid. What you cannot include would be tax refunds or credits that you expect to receive. So if you paid $5,000 but you're expecting a refund for $1,000 based on your state income tax return, then you would only be able to deduct the $4,000. You also cannot include any credits or refunds for a prior state or local income tax that you actually received. Instead, you need to see the Schedule 1 instructions, the IRS Schedule 1 for additional income and adjustments to income to determine how to properly report that. If you choose to use the state sales tax calculation, you should note that there are three methods to doing so. One is the actual expenses method, where you keep receipts and you claim expenses on that were paid on items during the tax year. You can use a tool that is on the IRS website known as the IRS Sales Tax Deduction Calculator, which you can find by going to irs.gov /sales tax. For this, all you need really are income statements such as 1099s and W-2s, quick grasp of your marital and dependent status, and then receipts for any significant purchases that you made during the year. Large appliances, vehicles, things of that nature. Or if you prefer, the form instructions contain a state and local general sales tax deduction worksheet, which you would use in conjunction with state and local general sales tax tables to be able to calculate your deduction. So it is a taxpayer's choice which method to choose. If you're going for accuracy and you're a detail-oriented person, you're probably best off using the actual expenses method, but you can compare that to what you would estimate in the IRS sales tax deduction calculator, which might be more convenient. Or if you want to see if you get a larger deduction by completing the tax deduction worksheet, you can use that as well. So depending on what your tax focus is, you may choose one of those methods for a specific reason. And as long as you follow the IRS instructions for each method, the IRS does not have an opinion on you using the method that produces the largest refund. You have 3 authorized options. You pick the one that is best suited for your situation. State and local real estate taxes. So once you've gone through the calculus of determining the income tax versus sales tax discussion, assuming that you have not already reached the $10,000 ceiling or the $5,000 for separate filers, you can go ahead and include any real estate taxes and then eventually personal property taxes. Again, if you have already reached the $10,000 limit, as many taxpayers may, this might be a completely unnecessary exercise. You don't need to do the additional work just to come up to a number that's even larger than $10,000. But if you do use this calculation, you can deduct real estate taxes on property you owned as long as it wasn't used for business. If you use property for business, there's a completely separate deduction that would go with your business return, or you would use it on Schedule C instead of Schedule A. Taxes must be assessed at a uniform rate on all real property in the community. The proceeds must be used for general community or governmental purposes. So for example, if you paid taxes that went to support the schools, that's legitimate. If you paid taxes that went to common services, that would be acceptable. If you live in a special district in the state of Florida, for example, they have what is known as community development districts, or CDDs. The fees that you pay to be a member of a CDD do not meet this criteria, so you cannot deduct them. You cannot include foreign taxes that you paid on real estate, and you also cannot include itemized charges that might appear on your property tax return. For example, you might get billed for trash collection, water consumption. If you had an ordinance violation for having a lawn that was overgrown and the city or municipality decides to hire a lawn service to maintain it, you cannot deduct that. You cannot include charges for improvements to increase property value. Repairs are acceptable, so if you had a sidewalk repair that was part of your assessment, you could include that. But if you were paying an improvement, so like to install sidewalks where they did not exist, you cannot include that. You can only include taxes that were actually paid and assessed either during the current year or in a prior year. You cannot include prepaid taxes. For example, in 2023, if you received an assessment for 2024 real estate taxes, you would not be able to pay that in 2023 and take the deduction. You would have to wait until 2024. You also must reduce your tax deduction by any refunds or rebates actually incurred. State and local personal property taxes. If your state sales or local or income tax plus your real estate tax did not get you to that $10,000 ceiling, then you can include personal property taxes, as long as they were based on value alone, imposed on an annual basis, and not prepaid. For example, if you pay an annual fee to register your car, and part of your fee is based on the car's value and part of it is based on the car's weight, you can only deduct the assessment based on the value of the car. You'll notice down here on line 6 that there is a line for other taxes where you list the type and amount paid. So in the form instructions, the other taxes paid include income taxes paid to a foreign country. However, you may be eligible for a foreign tax credit, which you should probably determine before you include that in Schedule A. If you're eligible for a tax credit, then that's probably the better way to go because a tax credit reduces your income tax bill, which is always preferable to a tax deduction, which reduces your taxable income. Generation skipping tax imposed on certain income distributions. Most taxpayers will probably never see this tax in their life. However, if this is something that is pertinent to your situation, you can include that in Schedule A. Do not include taxes paid to a U.S. possession because we've addressed that so you would use the appropriate state and local tax line that was reported. And then do not include a state tax that you might have paid on income in respect of a decedent, IRD income. Instead, you would use line 16 on Schedule A. So line 16 is further down the form. It's right here under other itemized deductions, and we'll cover that in a separate video. That's all we have for this video on calculating taxes paid as part of an itemized deduction that you would list on Schedule A. You can check out our full-length article where we go into taxes paid and everything else about filing Schedule A on our website. Simply go to teachmepersonalfinance.com, type in IRS Schedule A in the search bar, and you should see our article appear. Also, you should see in the show notes links to the Schedule A article as well as other videos for itemized deductions that may help you as you calculate your itemized deductions. So if you have any questions, please post them in the comments section. If you do like our YouTube videos, please subscribe to our YouTube channel. Thank you very much and have a great day.